All right, welcome class. So today we're going to dive into a pretty specific but really important corner of the Income Tax Act. We're talking about what happens from a tax perspective when a mortgage goes into foreclosure. It's a situation with some big and honestly often surprising tax consequences for everyone involved.
We're going to be looking at this from two main angles, right? First, from the perspective of the debtor, that's the person losing their property, and second, from the creditor's side, the bank or lender who's taking it over. You'll see the tax rules treat these two sides in a very specific, almost mirrored way.
So here's our game plan. We'll start with the basics. What exactly is a foreclosure? Then we'll walk through the tax effects for the debtor, and then we'll do the same for the creditor. After that, we'll put them side by side to really see how it all connects. And finally, we'll boil it all down to the core principles you absolutely need to remember.
Okay, let's get into it. Before we can even start talking about the tax implications, we need to have a crystal clear understanding of what a mortgage foreclosure actually is.
So the setup is pretty straightforward. A borrower can't make their payments, they default, and the lender takes the property that was put up as security. But, and this is the crucial part, this isn't a sale in the normal sense. No money is changing hands here. It's a transfer of an asset to settle a debt. And that fundamental difference is exactly why the tax system has its own unique way of handling it. And this is where we need to focus. The Income Tax Act actually carves out special rules just for this scenario. You can't just apply the normal rules for selling a property because the whole nature of the transaction is different. The big one being, of course, that there's no cash being paid for the property in the way we usually think about it. First up, let's put ourselves in the debtor's shoes. This is the person or the company that defaulted on the loan and is now losing their property. What does the tax world look like for them? So from the debtor's point of view, you've got two huge things happening at the exact same time for tax purposes. First, their debt is wiped out. It's gone. And second, they have in effect disposed of their property to make that happen. Now, this is the absolute key. The law creates an artificial selling price. We call this concept deemed proceeds. And in a foreclosure, the deemed proceeds are set equal to the outstanding principal of the loan. It doesn't matter what the property's fair market value is at that moment. The selling price, for tax purposes, is locked in. It's the amount of the debt. Okay, this slide makes it real. Let's look at the numbers. The outstanding debt is $500,000. So that becomes the deemed selling price. Now, we compare that to what the debtor originally paid for it. Their adjusted cost base, or ACB, which was $400,000. Well, the deemed proceeds are higher than the cost, and that means we have a $100,000 capital gain. Now think about that. This is critical. The debtor, who's in financial trouble and received zero cash, now has a tax bill. It's a tough situation, but it's a very real consequence of how these rules work. Okay, so now let's flip the coin. Let's look at this from the other side, from the creditor's perspective. Think of the bank or the lender who is now taking possession of that property. For the creditor, their asset has just changed form. On their books, they used to have a loan, an amount receivable. Now that receivable is gone, and in its place, they have a physical asset, the property itself. They've basically just traded the loan for a building. And here's where you see the beautiful symmetry in the act. The creditor is deemed to have bought the property for the exact same price the debtor was deemed to have sold it for, that principal amount of the outstanding debt. The tax system creates this perfectly mirrored transaction. It's really quite elegant. Now, there is one little adjustment you need to be aware of. If the creditor, in a prior year, saw this loan was going bad and claimed a reserve for a doubtful debt, that reserve amount has to be subtracted from their cost base in the property. This just prevents them from getting a double tax benefit, once on the reserve and again on the cost base. So let's look at our example from the creditor side. For them, the foreclosure itself isn't the main tax event. That principal debt of $500,000 becomes their deemed acquisition cost. It's their new ACB for the property. And assuming they didn't claim any reserves, their tax consequence is kicked down the road. A gain or loss will only happen when they eventually sell that property to somebody else. That future sale price will then be compared to this new $500,000 cost base. Okay, so let's put it all together. Let's look at this side by side to really see the complete, elegant picture that the Tax Act paints for us here. And this just illustrates it perfectly, doesn't it? It's two sides of the same coin. For the debtor, it's a deemed sale. The proceeds equal the debt, and that can trigger an immediate tax problem. For the creditor, it's a deemed purchase. The cost equals the debt, and the tax consequence is deferred. The debtor's sale price becomes the creditor's purchase cost. It's a perfectly mirrored transaction under the Income Tax Act.
So, as you're studying for exams or thinking about your future careers, what are the most important principles you need to walk away with from this explainer? What's the bottom line?
These right here, these are your non-negotiables. You have to know these. First, a foreclosure is a deemed transaction. Second, the linchpin, the key number for all the calculations, is the principal amount of the debt. Third, the debtor faces the immediate tax hit while the creditor gets to wait. Their consequence is deferred. And finally, always remember the symmetry. The debtor's proceeds equal the creditor's cost. If you can keep these points straight, you can analyze any foreclosure problem that comes your way.
And finally, I'll just leave you with a little food for thought for our next class. This isn't just about technical rules, right? Think about the real world here. How might these tax rules actually influence a bank's business strategy? Does the chance to acquire an asset at a specific cost base make foreclosure more or less attractive than, say, trying to work out a new payment plan with a struggling debtor? We'll pick this up next time. Class dismissed.